Hi everyone, in this video we're going to be looking at Chapter 4, and in Chapter 4 we're going to dive into the accounting cycle and look at the idea of journals and journal entries and the ledgers, etc. So let's get started. Okay, so we're going to begin by talking about the transition to debits and credits. And when we started the class out, we had this notion of increases and decreases as kind of the first step, right? Just understanding a specific accounting transaction and then being able to translate that into increases and decreases to assets, liabilities, revenues, expenses, etc. But we also had the idea of the T account where we had increase and decrease, and we had increase and decrease, on different sides on the left and the right, etc. And so the idea of debits and credits is really the same thing as the increase or decrease on the left and the right, but we're just adding some of the formal language, and we're going to be using the terms debit and credit in regard to increases and decreases in this chapter and then going forward as well. Sometimes you'll see as it notes here debits represented by DR and credits with CR, so keep that in mind if you see those abbreviations, debit and credit. And really remember, debits on the left, credits on the right, debit left, credit right. That's really the only connotation you should have with these terms, but you do need to understand what side, left or right, is an increase depending on what type of asset or liability, what kind of account that we're talking about. So as it notes here, debits does not always mean decrease and credit does not always mean increase. Again, it depends on what type of account we're talking about. And here we saw a similar diagram, I believe, earlier in the chapter, maybe in chapter 2 or 1 when we started talking about T accounts. And so remember, we got increases and decreases and then opposites for accounts of the liabilities versus the assets. And now we're just going to take into account that the terminology of debit and credit represent left and right in the T account. Okay, so nothing new here in terms of how we're using the T accounts or anything. It's really just more of a terminology change, and coming to understand the concept of debit and credit. And again, just remember debit on the left, credit on the right, and that's really all that it means. But we do need to remember which left or right is an increase or decrease depending on what type of account we're talking about. Okay, so we've already talked about quite a bit about having two parts to every transaction, at least 2 parts, 2 entries. And we have to have the value, and now that we're using debits and credits, earlier when we were talking about that concept, we would have to balance out essentially in terms of the accounting equation and the left and the right, so on and so forth. And so in terms of transitioning that language to debits and credits, instead of us saying the left and the right side of the accounting equation have to always balance, now we can say the value of a debit, the debits and the credits for any given transaction have to be equal. And this concept is known as double entry. And basically what we are referring to there is that the total of all debits must equal the total of all credits. And you could have 100 debits and 1 credit, or 50 debits and 25 credits, or whatever. You have to have at least 1 debit and 1 credit, but you could have as many on each side of the equation as long as the totals are equal. And yeah, as it mentions here, if debits don't equal credits, then you're out of balance. And you can kind of see some examples of transactions here. So we have in this first example, earning of cash and revenue. So we have an increase to cash and an increase to revenue, debit and a credit. And again, how we know that revenue is an increase with a credit gets back to understanding this diagram, and the increases for revenues are credits, whereas the increases for assets are debits. So you can kind of see a credit and a debit. Paying down debt here, we can see cash going down with a credit. So you can see it's the opposite, right? cash being an asset goes up with a debit, down with a credit. Notes payable, which is a liability, goes opposite, so it goes down with a debit and up with a credit. Paying for prepaid insurance as an initial purchase of the prepaid insurance, cash going down. So one asset down, one asset up. You can see them both on different sides here. So a credit will be the decrease to this asset, and a debit will be the increase to the prepaid insurance. This transaction is showing getting an invoice for maintenance expense. And so we have expense with a debit to increase, again, increase on the debit side, and then an increase to our liability with the accounts payable going up, increases go here. And so it really just comes down to understanding and kind of memorizing this breakdown of debits and credits and left and right. Okay, let's take a quick look at one of our questions here. So in the debit and credit system, debits are always recorded on the left. Remember, that's all we really, now it's depending whether the debit or credit is an increase or decrease, depends on the account, but it's always on the left. That's what we mean when we say debit. Okay, here we have another question. An increase to an asset should always be and then we could go back to this diagram. Increases to assets will always be debits. So we'll have B as our answer there. An increase to an expense is always a debit, and that was just from our chart. And true or false, depending on the type of transaction, you can have either only 2 debits or only 2 credits. That sounds odd. I'm not sure what they're getting at there. You always have to have a debit and a credit. That's just confusing wording to me. But what you keep in mind, despite a slightly confusing question, you should always, the total of all the debits and credits for any given transaction, that is to say, the total of all the increases and decreases, have to balance. So that's the rule to remember. An increase to a liability is a credit, so it increases on the credit side, which is the right side. Okay, and that brings us to the end of our questions here. And pardon me for one moment, you might hear my dog whining in the background, so I'm about to let him out, and I will be right back. Okay, sorry about that interruption here. One thing I wanted to talk about for a minute here in regard to the debits and the credits and the trying to memorize those left and rights and increases and decreases and all that. There's a really handy acronym here. I believe that's the name of this, or a mnemonic device, however you say that, that can help you kind of memorize which side, either debit or credit, is an increase. And because there's only 2 options, either increase or decrease, if you know the increase, then as long as you know, for example, that an asset increases with a debit, by logic, that also tells you that an asset decreases with a credit. So it's kind of a binary system where there's only two options, increase or decrease, essentially. And so this little mnemonic device kind of memorization helper type thing here is dead circle. And so if you remember this term, so D-E-A-D, dead, and then you've got it kind of here with the D being the debit, and then circle with the C for credit, and C-R-C-L, if you can remember that, not fully spelled out like dead is, but C-R-C-L. So you got kind of a truncated word there, but if you remember that this just kind of get that in your mind. What this helps you understand is, like I just mentioned, what's either debit or credit. So what side of the T account do these accounts increase on? So for expenses, assets, and draws or withdrawals, remember when an owner takes money out of the business, technically you might see in the book in terms of withdrawals, but think of it just as draws, as the same thing. This indicates, so the debit side, or the left side, is the increase for expenses, assets, and draws. So again, expenses, assets, and draws are increased with a debit. So can you kind of see that? So if you can memorize DEAD, dead, then you can remember E for expenses, A for assets, D for draws, and all those things increase with a debit. So it fits in with the DEAD. And remember, what we're saying is that each of those increases with a debit. So that also means that they decrease with a credit, because there's only two options, either debit or credit for an increase or decrease. And then alternatively, on the credit side, so you've got circle, so D on this side, debit, credit. So on the right side, we've got circle. And under the circle, we've got R for revenues, C for contribution, so remember putting money into the business, and then L for liabilities. And so CRCL. And again, just like with this side, what we're saying with these types of accounts, that they increase with a credit. So they increase on the right side of the T account. So revenues increase on the right side, the credit side, contributions increase on the credit side, and liabilities increase on the credit side. And again, by contrast, because we know that these accounts increase with a credit, we also know that they decrease with a debit. So if we want to reduce a liability, maybe say make a debt payment, a principal payment on debt, and we'd have cash going down and we would have debt going down. If we know that cash is an asset and we know that a debt, a notes payable, for example, is a liability, and those are both going down, if we understand this dead circle acronym, we know that they would go up with a debit for assets. So we need to credit the asset to decrease it. And we know liabilities go up with a credit. So we need to debit that liability to decrease it. A more direct example, say you earned money, you were paid cash for providing some service. And so remember the entry there, the transaction, the accounting would be an asset, cash goes up, and revenue goes up as well. And so if we remember our dead circle and we need to know the debit and credit, then we know cash is an asset, assets are under the D, the DEAD, so they increase with a debit, and revenues are over here under the credit part of this mnemonic device. And so we could remember that debit, asset, increase, revenue under the circle part, so it's going to be a credit increase. And then we know that we need to debit the cash assets, so we put the transaction on the left, the amount on the left for that cash asset, and then we put the amount on the right for the credit part of the revenue, essentially. So hopefully this is helpful for everyone. It is a little bit of memorization you have to do to get comfortable with the debit and credit, left and right, increase, decrease. But I find this to be pretty helpful and handy in memorizing how those how those transactions are recorded. So I just wanted to spend some time here showing you that, and hopefully that will help y'all. And you can write this on your quizzes or exams at the top of the paper if you memorize it, just to give yourself kind of a baseline reference tool, so on and so forth. So it's nice to have those kind of handy tools until you do this a whole lot of times and it starts to become a little bit more of a automatic response, muscle memory type thing once you've done a lot of accounting transactions. Cool. Okay. Let's jump back over to our other PowerPoint now. Okay, so continuing on with our slides here, in Chapter 4, we have now talked about debits and credits as far as left and right, increases and decreases. We talked about the dead circle memorization tool, and now we're going to talk about the overall accounting cycle. And when we mention this whole idea of the accounting cycle, you can see a diagram of it here. And it's really this idea of the whole process of accounting, from analyzing the initial transactions, recording these in a journal as a journal entry, posting these to the ledger accounts, preparing a trial balance, posting adjusting entries, preparing adjusted trial balance. Then we're going to create financial statements, which we've seen already. I know some of this might seem a little foreign at this point. We haven't really talked about any of these concepts, but we have talked about financial statements. And then we're going to do some of these things called closing entries and then prepare a final trial balance. So really the whole process of this is how we get from just the transactional analysis all the way to creating our financial statements and finishing up the accounting cycle. And so we're going to work through these steps in this chapter, in the coming chapter, and we'll take a deeper dive on the different steps as we go. And we're going to start with analyzing transactions. So we've already been doing this throughout the book already. When we say analyze transactions, really we're talking about just gathering information, analyzing what must be recorded. And so we've been doing this, like I mentioned, from chapter 1, chapter 2. This is just analyzing something happening and then translating that activity into accounting and increases and decreases. And now in chapter 4 here, as we start to use the terminology of debits and credits, we're going to put it in that language. And really in the real world, in our book examples and our work problems in class, typically we're just telling you something happened. If it says, oh, you made a payment on a loan or received some revenue for providing services, so on and so forth. That's always just in the form of a sentence in a textbook, for example. But in the real world, this information is not, being provided to you in a textbook format like that, but more so the accountants are getting some sort of source documents, and that could be all different types of things: sales receipts, bills, checks, bank statements, etc. And so that's part of the job of the bookkeeper and the accountant, is to go through all these source documents, and that's really what we're using to record the transactions. So here's an example. Suppose you pay a $100 utility bill with cash. To analyze this, first determine which accounts will be affected, and then we have to ask the following questions. What category does the account belong to? Is the account increasing or decreasing? And is the increase or decrease a debit or credit? And just to answer this question as we go through, so what category do the accounts belong to? So we can see here that assets have decreased. We've paid this bill with cash. We've incurred an expense for utilities, and so that's an expense. And so cash is going down and expenses are going up. Remember our dead circle. So DEAD, so cash is an asset, it's under the D, so it increases with the debit. But here in this transaction, we need to decrease it. So we know that it increases with the debit from the dead circle. Then we also know that it decreases with a credit. So we're going to credit cash for $100, and then we think in our minds, okay, expenses is also in the DEAD side of our debt circle. And we know that expenses, because it's under the D, increases with the debit. We're trying to increase expenses. And so we can basically use that memorization tool and know that expenses are an increase with the debit. And again, we're increasing expenses, decreasing assets. And so we would debit the expense to increase it and credit the asset to decrease it. Okay, so so this is just like I said, same thing, just walking through this whole process, this thought process. It's really important. I think that this is the proper thought process that you need to develop to be good at accounting. And so just being able to work through this logic on a continuous basis is one of the key things that I would hope that you come out of this class being able to do. And it's really the foundation of being able to do accounting properly. And then they just kind of illustrate it here with the diagram. So here's a whole list of different transactions. We will, this is a lot of information that would be best provided in class and as a as an exercise for you all to work through. So I'm just going to kind of go through relatively quickly with this part, and we'll do a lot of those in class. Okay, so, but generally speaking, from a theoretical perspective, or just the overall theory of the debits and credits, when we are doing our work with this analysis of source transactions, we're going to arrive at a place where we understand what needs to be done. We know we need to debit a certain account, and we know we need to credit a certain account. Again, remember, it has to be at least two different debits and credits that the totals have to balance. The amounts have to be equal. But it could be any number of debits or credits as well, as long as the amounts are equal. And what do we do with that information? So in the real world, we could sit there and we could think about it, and we say, oh, we earned revenue from providing services and we were paid in cash. So we know that we need to debit cash and credit revenue. And so what we do with that information from a practical standpoint to actually record the accounting information into our accounting records is this process of journalizing, or creating journal entries in which they will be recorded into the general journal. And this is this is where we initially record transactions. They're done in chronological order, the order in which they occur. So the way that the general journal is laid out is January 1. If you had a transaction, that's the first. January 2nd, 3rd, 4th. That's what chronological means, basically. And the journal entry will have different information. It will have the date of the transaction, the account and the amounts to be debited and credited, and a brief explanation of the transaction. And here's a little bit of an example for you to reference of what a journal entry will look like. And so here we've got the cash account. And this is similar to what I was just saying in my example. So if we received cash for providing some services, we know cash is going to go up. We know revenue is going to go up. We know cash is an asset. It's under the D in dead circle. It increases with the debit. We know that the revenue is under the C in our dead circle. It increases with revenue. So we're feeling good with the debits and credits. And then this is just how we lay it out. We put the date that the transaction happened. We put the debits will always go first, so put your debits first and then your credits afterwards. And then the debit and credit have their own columns. We have to have at least one debit and one credit. They have to equal, as you can see they do here. And then you just have a quick explanation down here, for example, completed work for client. So some sort of explanation. And in the real world, these explanations are very important because when you in the future might need to reference back to a specific journal entry to understand what was happening and why this journal entry was posted, you'll want to have some information included there that would allow you to understand what was happening, essentially. And so it's really for your own benefit. These explanations for our academic purposes and classwork purposes, they're not, it's not like we're going to have to go back and review prior work at any point in the class, and we're going to use these to do that or to better understand what's happening necessarily. But just know that these explanations do exist, and we will be putting them in as we're doing our work. Okay, I don't really care too much about the posting reference. A little bit, some of this information, like the posting reference, is a little bit outdated. This is hearkening back to a time when there was actually a physical book and these things were being written down, and you would use the posting reference to understand where different information was coming from. But in today's modern age with accounting softwares like QuickBooks, it automatically does the organization for you. And so this idea of the posting reference becomes kind of obsolete in modern accounting software. But as I mentioned, here's the proper formatting: debits first, and also the debits are, you can see against the margin here, and then the credits are indented, and that kind of follows how the debit and credit columns are laid out. Sometimes you have journal entries that affect more than 2 accounts. As I mentioned before, you can have any number of debits and credits. They just have to equal, so it doesn't have to be just one and one. Some examples of that would something that would be, and it's called a compound journal entry. An example of a compound journal entry that they show here is, it says that suppose you purchase equipment for $5,000, you pay $1,000 cash at the time of the purchase, and then you take on debt for the remainder of the $5,000. So you paid $1,000, you owe $4,000, and you got a piece of equipment worth $5,000 total. You just haven't paid all the cash yet, but you owe it, right? So you have a liability for that amount. So equipment is an asset, so it's going to debit to be increased. So here we're going to put that equipment as our debit for $5,000. We paid cash, so that's a decrease to an asset. And dead circle tells us that assets increase with a debit. So by that logic, they also decrease with a credit. So it'll be, you see the cash being credited here. And then we know that we have a new liability. We're going to use the accounts payable account to reflect this amount that we owe for the remainder of the $5,000 that we haven't paid yet. And we're going to call that, we're going to use the accounts payable account. It's a liability. Remember that liabilities are under the circle and dead circle, so they are a credit increase under the C. And so that's what we can see here, a credit to show that we've increased the liability by $4,000. We've decreased an asset by $1,000, and we've increased an asset by $5,000. Okay, so compound journal entries. So they're not always just one and one is the main takeaway there. Sometimes you have any number of debits and credits, and in the real world, sometimes you have some really big journal entries, especially for payroll and certain types of transactions. You could have hundreds of debits and credits in a real world scenario. But the key thing, as we've mentioned numerous times here, is that you can have as many as there can be, but just all the debits have to equal to all the credits. So here you can see 4,000 plus 1,000 is 5,000. So our total credits are 5,000, and we just have the one $5,000 debit. So they do balance. So true or false, every journal entry will have at least one debit and one credit. That's what I just said, so that is true. Which of the following is normally true about the order of line entries within each journal entry? Debits appear together before credits. Yeah, that's the kind of thing that the one of the formatting rules is that typically we always have the debits, and you'll have them together, and they will be before. So when we say before, they're on the top of the journal entry here. If there was 2 different debits that we had to account for, we'd just have one here. But if there was 2 different ones, you would have 2 debits, and then the credits would be below those. And so that's the answer there. Okay, so now we know how to analyze these transactions. You know, we've been practicing that since day one, basically, but now we're talking debits and credits to reflect increases and decreases. We've learned about journal entries, so when we are actually doing the accounting and we're putting it into our records, we're using journal entries. And then the next step after doing the journal entries is to post to ledger accounts. And so the term ledger and general ledger is this term that represents essentially all of our accounting information by account, and it would show all of the debits and credits to a specific account. So again, the general ledger is a record that contains all of the asset, liability, equity, revenue, and expense accounts. So each account in the general ledger has its own little area, and within that specific area, for example, in the cash area in the general ledger, it'll show each debit or credit that has specifically affected cash. And then if you were to look at, say, revenue, if there was a revenue and cash going up, you know, you would look at the revenue account and it would show an increase. You would look at the cash account, it would show an increase. You've basically like broken apart that journal entry and put each increase or decrease into the respective activity and the respective section for that that specific account, either cash, service revenue, etc. And we'll take a look at that and we'll practice with that quite a bit. I know that it's a little bit confusing at this point before you see what I'm talking about, but stay with me there. One thing we want to keep in mind, this is called the chart of accounts. And I like to think of the chart of accounts as kind of like a menu that just lists all of the accounts that are created, that have been created, and what their account numbers are. And so the way that this is used in a modern accounting software, for example, is you could usually go in and just type in like 101, and when you're doing a journal entry, for example, and it would pop up with cash, and then, okay, that's cool, that's my debit line, I put the amount in, and then maybe I hit tab and it goes down to the next line of my journal entry, and then I put in 400 and service revenue pops up. So these are just identifiers. They're not amounts or anything like that. They're just like the number that is correlated with that specific account. And the chart of accounts, again, is just like a whole listing of all the accounts that we have that are active and what their account numbers are. And then the general ledger, how that relates to this is you could, for example, drill into cash, and in the ledger it would open up and you would see all of the debits and credits specifically to the cash account. And if you closed it back out, maybe you look at service revenue, the ledger account in the part of the general ledger where service revenue is, again, you would see all the debits and credits just specific to revenue. So they're showing that here. It's a little bit of complex with all the arrows and stuff going on, but let me try and break this down for you a little bit to hopefully make it more understandable. So as I mentioned, here's our journal entry. We've got our debit for cash, credit for revenue. Let's ignore this posting reference for now, but we've got our little explanation here. We know dead circle, so we did our journal entry right. And so this is like step one, and then step two is to kind of, so you record this in the general journal, and then you would go to the general ledger record book, and you would put the debit in the cash section. Here, 1,500 comes here, and then you would put the credit for the revenue in the revenue section, and you can see that here. Okay, so it's basically the same information. We're just breaking this information apart to aggregate all of the debits and credits that affect cash, for example, in one place. That's what's happening here. And then you always have a running balance with the ledger in the ledger account. And so if we started with a $3,000 opening balance, and what we said is we are increasing cash by 1,500, we have a debit. And so this running balance will show us, okay, we started with 3,000, we added 1,500, and now we have 4,500. Okay. If it had been a credit of 1,500, this number would be 2,500 or 1,500. Sorry, because a debit balance, and you can see whether it's a debit or credit by what's listed here. DR for debit. Debits increase debits, but if we had a credit, like I mentioned, it would reduce the debit balance. It would still be a debit balance, but it would be reduced down to 1,500 if this was a credit. Okay. I think the best way to learn this too is to practice it. So this is just a brief overview, and I'm going to kind of skip through some of this technical work because I think being hands-on with it is really the best way to feel comfortable with putting the information together. But hopefully that gives you kind of an overview. Let's see, true or false, all journal entries should be posted to the general ledger. That's true. That's just a part of the process. Okay, so now let's step back here. We've analyzed our source documents. We've done journal entries. We've taken those journal entries and recorded that journal entry activity into the general ledger. So for the cash and the revenue, for example, we've recorded the individual, we've recorded the amounts into those areas of the general ledger. And once we've done all of our accounting work for the whole month, for example, so now we have this ledger, this general ledger, and these individual ledger accounts like cash and revenue, etc. The general ledger is just the overall collection of all those, but the individual accounts that have their own ledgers, with all the activity. It basically gives us an ending balance in each account. And so we're going to take those ending balances then and prepare something called a trial balance. Okay. And so what a trial balance is it's just a listing of all of the ending balances at a given point in time, and it will have all of the accounts that have balances. Essentially, we want to have all of the accounts here with all their debits and their credits, and we total them up, and we want to see that they equal. Because again, if our debits and credits don't equal after we've done all of our work, then we don't balance, and that's a problem. As it mentions here, something that can often happen is a transposition where something like 530 is written at 350. And so if there is any of those errors as we're putting journal entries in and posting them to the general ledger, then that will be reflected here. If there was an error, these totals wouldn't balance. So it doesn't tell us, again, we talked about this in an earlier chapter, your debits and credits can still balance, and you can still have errors, though, in your accounting records because, for example, you could just record a transaction twice. So cash maybe should have only gone up by 1,000, revenue up by 1,000 to reflect that transaction. But maybe there was a mistake and we accidentally recorded 2,000. We recorded the $1,000 entry twice. So your accounting records will be incorrect, but they will still balance if you do all your debits and credits accurately. So there's ways that we catch things like that, a bank reconciliation, for example, which is something we'll look at later in the course. But just know that the trial balance, it has to balance. If it doesn't balance, you know there's a problem. But there are instances where it can balance and there can still be errors in the records. So some of the errors that would leave a trial balance, okay, so these are common errors, like I just said, posting something twice. Other ways that you can have issues but still have a balancing trial balance, you could have transactions that just weren't even recorded, right? Something could have happened and it just didn't get recorded because the source document didn't make it to the accountant, for example. A correct journal entry is not posted. A journal entry is posted twice, like I mentioned. You could have incorrect accounts that were used. So it was supposed to be an increase to cash and revenue, but maybe you accidentally recorded it to cash and expenses or something like that. You could still have debits and credits balance, but the incorrect accounts could be used. And then this says offsetting errors. So if you had two errors, but they offset, say you have a debit that's wrong by $100 and then a credit amount that's off by $100, those could zero out in essence and still show you balancing, but you would actually have errors in the record. So as it notes, locating errors can be a frustrating experience. So it is important when you're doing accounting work to be thoughtful and don't go too fast and try to have processes in place. Modern accounting software will generally have processes built within it, so that will call out potential errors, flag things that look weird or look off. And typically you can override those, but a lot of times that's a bad idea because it's probably telling you did something wrong. Like for example, if you post a journal entry into a modern accounting software and your debits and credits don't balance, the totals don't equal, it'll tell you, it'll say, hey, these debits and credits don't balance. I think you made a mistake. And so you'll have a chance to fix your mistake right there. That's a very typical, safeguard to prevent things from happening. And as modern accounting software has become very prominent and just kind of the standard for doing accounting work, those safeguards and those controls built into the software helps prevent a lot of these issues from occurring. But what is the main purpose of the trial balance here? Really to ensure that total debits equal total credits, which is very important overall. And then true or false, a general ledger can be prepared after the trial balance has been prepared. That's going to be false because the trial balance comes from the ledger. So false there. Okay, Let's spend a little time here in this chapter talking about ethics and internal controls. And this is just kind of built into a lot of the chapters here. We've talked about ethics a bit in the other chapters already. And I think the main thing that we want to touch on as far as ethical concerns here in chapter 4 is, there is the use of, or they're saying regardless of whether we use accounting software or record transactions manually, again, accountants are kind of the ones who are in the position to do manipulations of the accounting records, right? And when an accountant is manipulating the records, they're not directly doing anything, like they're not taking the cash per se. They're not, directly affecting those accounts. Or then, if they increase a debt account, a liability, and that's erroneous or fraudulent, it really didn't increase. It's not that the accountant is actually saddling the business with more debt, but they're obscuring the reality of the transactions and potentially creating false financial reports that then could be used to project some inaccurate picture to a user of the financial statements, essentially. So as I mentioned, and I think, we talk about fraud a lot of the time and that kind of thing, but really the most common situation that arises is just mistakes. And so using software to catch those mistakes, here it notes that, mistakes can be noticed but intentionally not corrected. Larger problems can arise later. So just being cautious, being honest, is really important to be a good accountant, because as the accountant, even if you're an entry-level accountant, a lot of times you are given a lot of responsibility for ensuring that certain business processes and business records are handled appropriately and accurately, etc. And then using internal controls, things like double checking authorization procedures. So that would be, it requires some sort of authorization from a manager, etc., to complete some kind of process. Double checking, I think this is built into software. Like I said, you can see it'll like red flag your inputs sometimes if they don't balance, etc. I think modern software too will continue to really be better at this as they integrate AI into the software, because it might see you putting to an account that you don't usually use or isn't typically used for a certain type of transaction. I think software will become better at identifying those potential errors and flagging them quicker. So that's good for us. Okay, and that brings us on to our summary slide here for chapter 4. And let's talk a little bit about what we covered again. We distinguished what we talked even what are debits and credits. Remember, debit is the left, credit is the right. That's really all there is to it. Sometimes it's an increase, sometimes it's a decrease. Sometimes debits are increases, sometimes debits are decreases. And the tool that you can kind of memorize to help you know which are sides and debits or credits or increases depending on the type of account is the dead circle little memorization tool. Here it tells you which ones. So assets, expenses, owner's withdrawals are members. We use the acronym DEAD. So debits are increases, and that's E for expenses, A for assets, and D for draws. That's the full word, owner's withdrawals, but D, it works better with DEAD. And then for credits, we've got revenues, C, so it increases on the credit side, CR, CL, the R is revenues. We've got owner's capital increases, I'm going to say contributions, or you could say capital, and then liabilities, so CR, CL, circle, yeah. So they all increase with credit. So it's just practicing with that mnemonic device to help you with the memorization of debits and credits. Okay, we talked about the accounting cycle and the whole idea that there's this ongoing process of analysis of source documents and other, whatever that source document is. It can be various things, but we need to understand, we have to receive information in as the accountant to be able to do the journal entries, etc., the recording of transactions. So once we get a source document in, we analyze it, we know our dead circle, we understand debits and credits, we can do journal entries. So we post a journal entry, and we'll practice with journal entries, but that journal entry includes all the accounts. So the one journal entry would have cash and revenue, for example, in it in one spot, one journal entry. We record that in the general journal. And then we post that journal entry to the general ledger, which means we take the impact to we take the increases and decreases to those accounts that we saw, and we put them into their ledgers, which are records of all of the activity for a given account. So if we add cash and revenue together in a journal entry, then we go to the general ledger and we just record the cash effect in the cash section of the ledger and the revenue effect in the revenue section of the ledger. And again, practice is going to help us understand exactly how to do that, but that's the overall idea. And so once we have all of the journal entries done, we have all the activity posted to the ledger, what that gives us at the end of doing all that is ending balances for each account. And then if we have the ending balances of all the accounts, then we just take those all and put them on this thing called a trial balance. And then the trial balance will summarize all the debit and credit ending balances for all the accounts. And if they don't balance, we can know something's wrong. Remember that just because they do balance doesn't mean we didn't make a mistake. But if they don't balance, we know we did something wrong for sure. And then we talked about ethics and internal controls related to recording and posting transactions, and reminding ourselves that as accountants, we are in a very sensitive position, and the work that we do can have some significant impacts on the business's financial records. And then if those financial records are used for different things, that can have an impact, etc. So we're kind of the gatekeeper to ensure that the business's information systems from a financial perspective remain accurate, transparent, honest, objective, etc. And we talked about internal controls such as double checking and authorization procedures that should be in place to detect and avoid errors in recording and posting transactions. So that's something we should be doing ourselves. And that's also something that is often built into modern accounting software. So for example, if you're posting a journal entry and the debits you put in and the amount for the debits don't equal the amount for the credits, it will flag, it'll give you some kind of warning, and it'll say, hey, this is an error, you need to go fix that. And so that helps us avoid mistakes. Okay, so that brings us to the end of Chapter 4's lecture. I do think that this information is good, but really this type of information is really going to need you to work with it to come to fully understand how to do journal entries and posting to the general ledger and doing the trial balance. So don't skimp on the homework or workbook exercises or in-class work in this chapter. This is one of the most important areas that we need to become familiar with to build up our skills and have a good foundation of how to do all these foundational accounting practices, because this really, all the debits and credits and understanding the flow in the accounting cycle is extremely important to be fluent in accounting and actually understand what it takes to complete the process each accounting period. All right. Well, thanks, everybody. I appreciate you all, and I will talk to you all soon. All right. Bye now.